Welcome to Talker Tickers. Today, we're digging into Bed Bath & Beyond's Q4 2025 earnings call from February 23, 2026. Let's break down what's really going on with this company.
Okay, here's what we've got on tap. We'll kick things off with the headline numbers, which were actually pretty good. Then we'll get into the weeds on their huge new strategy, the everything home ecosystem. After that, we'll look at their guidance, analyze the market's, pretty flat reaction, and then we'll give you our take with the next call. And of course, a quick disclaimer at the end.
All right, first up, the headline beat. And on the surface, you'd think things were looking up. Bed Bath & Beyond definitely posted results that were better than Wall Street was bracing for.
So get this. They reported a GAAP EPS loss of 30 cents per share. Now, a loss is a loss, but analysts were expecting a 43-cent loss. So that's a solid 13-cent beat right there.
And it wasn't just on the bottom line. Revenue also came in stronger than expected at $273.4 million. That's over $10 million more than the consensus estimate. Now, we should point out that's still down almost 10% from last year, but a beat is a beat.
Okay, but this is where the story gets really interesting. Forget the top line for a second and look at the profitability metrics. Gross margin expanded by 160 basis points. The adjusted EBITDA loss shrank from $27 million last year to just $4 million. That's a massive improvement, and it shows management is finally getting some real operational discipline in place.
So, that leads to the big question, right? If they beat on the top and bottom line, why didn't the stock pop? Well, the answer lies in management's brand new, incredibly ambitious, and let's be honest, pretty complex new strategy. You're calling it a three-pillar ecosystem, and the goal here is to move way beyond just being an online store that sells you towels and kitchen gadgets. They're trying to build a whole integrated platform for the home. So here's the blueprint. Pillar 1 is the retail business you already know, Bed Bath & Beyond, Overstock, and soon, Kirklands. Think of that as the front door to get customers. But pillars 2 and 3, that's where they expect to make the real money. They're talking about high-margin services like insurance, warranties, mortgages, and even home installation. I mean, they're tossing around potential gross margins north of 50% for the financial stuff. That's a whole different ballgame.
CEO Marcus Lemonis put it this way, and I think it's important. We are aggregators, not consolidators. He's trying to say they aren't just buying companies for the sake of getting bigger. The idea is to build a connected system where each part helps the others. But let's be clear, this is a massive long-term bet on a total business transformation.
Okay, so if you're going to make a bet that big, you need a roadmap. Management gave us a look at what the year ahead is supposed to look like, with some key things for investors to watch. And here's the play-by-play for fiscal 2026. Q1 is about stabilizing the ship. They want to see revenue growth again and a big jump in EBITDA. Q2 is going to get messy. That's when the Kirklands deal closes, so expect a lot of integration costs and noise in the numbers. It's really not until the second half of the year, Q3 and Q4, that they expect us to see the actual benefits start to flow through. And that stretch goal of getting near profitability by year-end, that is ambitious.
So you've got the earnings beat, you've got this grand vision for the future, and the market basically shrugged. The reaction was incredibly subdued, and this really gets the core of the problem for the stock right now.
And this slide really nails the disconnect. On the one hand, management is selling this incredible, long-term story. On the other hand, investors are looking at the here and now, and they see a ton of risk. All the M&A, all the complex integration, it's a huge execution challenge, and the market is in wait-and-see mode.
And the proof is in the pudding. The stock moved less than 1% in after-hours trading after the call. That is hardly a vote of confidence from investors.
And if you want to understand that skepticism, just look at this chart. Over the last year, Bed Bath & Beyond stock has gotten crushed, down over 30%. Meanwhile, the broader retail sector is up almost 15%. That is a massive underperformance. So investors have been burned, and it's going to take more than one decent quarter to win them back.
So, let's pull all this together. What's our call on Bed Bath & Beyond as we look ahead to the next quarter?
This is the multi-million-dollar question, isn't it? Is this thing a buy, sell, or hold? You've got a company that's finally established a bottom and laid out a bold vision, but the execution risk is just massive.
So here's our preview. For Q1, we expect them to hit their numbers. The real catalyst, though, won't be the financials. The things to watch are, number 1, do they actually close the Kirklands deal? And 2, do we get any real updates on the other acquisitions they'll need? Until then, we think the stock is going to stay range-bound.
The market is in full show-me mode and needs to see this plan turn into actual, sustainable profit. For all those reasons, our rating here is market perform. We have to acknowledge the progress they've made on cleaning up operations. But we believe the stock is fairly valued right now, given the huge amount of uncertainty and the hurdles they face in actually building this ecosystem.
And to wrap up, just one final crucial point.
Just a quick reminder, this analysis is for informational purposes only. This is not financial advice.